Before I get into all of the 8 areas of a holistic financial plan, it's really important to understand before an advisor gives you any sort of financial advice, they first of all need to understand your goals and your objectives. If they're looking at giving you any advice without understanding your goals and your objectives, that is not the right way. Now, the 8 areas I'm going to be breaking down today are superannuation, debt management, retirement planning. The first pillar I'm going to be breaking down is superannuation. Now, the things you need to understand about superannuation is you cannot access your superannuation for retirement purposes or for any reason really until you reach age 60 here in Australia. From age 60 to 65, there are various conditions that you can reach or meet, and then you can start gaining access to your superannuation. One of them would just be simply retiring. The other one would be leaving an employment arrangement. Welcome back to the Winner's Playbook. Today's episode is going to be a little bit different. It's just going to be me solo here today, Josh, and I'm going to be running you guys through the 8 pillars of the holistic financial advice process. So my co-host Billy is over in the US currently enjoying his time up. I'm still down here in Melbourne. So I'm going to be running the podcast solo today, and I'm basically going to be breaking down the 8 areas of financial advice one by one, talking about the ins and the outs and how we as financial advisors actually go about piecing together a financial plan for a client's circumstance. Now, this could be for you if you're in the accumulation phase, you're looking at building your wealth, you're in the retirement phase, you're a business owner, whatever it may be. I'm going to be breaking it all down today on the podcast. And of course, if you have any further questions in relation to any of these areas that I am speaking about, always best to reach out to your financial advisor. So before I get into all of the 8 areas of a holistic financial plan, it's really important to understand before an advisor gives you any sort of financial advice, they first of all need to understand your goals and your objectives. If they're looking at giving you any advice without understanding your goals and your objectives, that is not the right way. That is not good advice. So first and foremost, the advisor will always start by getting an understanding around your goals, your objectives, the short, the medium, and the longer term. What are you trying to achieve now and into the future? What does your end goal or your North Star look like? What does retirement look like? Talking about family, lifestyle, whatever it may be. Once the advisor understands all of those areas and what those goals and objectives are, and their role is ultimately to help you get clarity on your life as well, only then can we move on to the holistic advice areas. Now, the 8 areas I'm going to be breaking down today are superannuation, debt management, retirement planning, tax minimization, personal and asset protection, estate planning, investing outside super, and cash flow maximization. So I'm going to start with superannuation, break down the ins and the outs, and I'll walk through each of those areas. And hope you get some value out of what I'm going to be talking about today. So the first pillar I'm going to be breaking down, superannuation. Now, the things you need to understand about superannuation is you cannot access your superannuation for retirement purposes or for any reason really until you reach age 60 here in Australia. From age 60 to 65, there are various conditions that you can reach or meet, and then you can start gaining access to your superannuation. One of them would just be simply retiring. The other one would be leaving an employment arrangement. So it doesn't mean you never work again into the future. It just means you leave an employment arrangement after the age of 60. Your super can become entirely tax-free. The other way you can start accessing superannuation from age 60 is through something called a transition to retirement account. It allows you to access up to 10% of your fund up until the age of 65. And then from 65 onwards, for superannuation purposes, your fund is entirely accessible no matter what at that point in time. It does not matter if you're working or not. From 65 onwards, your superannuation becomes entirely accessible. The other things you then need to know, what an advisor is going to do with you is look at the ways that they can actually help you further grow your superannuation. There's pretty much 3 main ways you can grow your superannuation quicker. Number 1, you can reduce your costs. Now, there is a limit to how much we would focus on this as an advisor, because ultimately there are some really cheap products and funds out there in Australia, but as in a lot of things, cheap doesn't always necessarily correlate to quality. So yes, we want to have a grasp of fees. We don't want to be in an expensive product, but we don't want to compromise on the fund or the platform that we're utilizing, because if we do, that might mean low rates of return, which will ultimately lead you into a worse financial outcome. So having costs under control is really important, but it's not the main lever we generally would focus on as an advisor. The second one will be looking at, do we make any extra contributions to superannuation? There's no exact formula for this, but the things to consider would be, is your age. If you're in your 20s or your 30s, are you willing to put money into your superannuation and lock it away until age 60? Maybe, maybe not. A lot of the clients that we work with do want to have optionality around their retirement in their 40s or their 50s, depending upon their age. And therefore, if they put any of their extra money and invest into their super, that's not going to help them achieve their goals. Now, if you want to retire after the age of 60, superannuation is your best friend. The most tax-effective environment in Australia. The investments are taxed at 15% along the journey. From age 60 onwards, it can be entirely tax-free, up to an amount of $2 million per person in a couple. So you can't beat it from a taxation point of view. But the major downside to superannuation is the accessibility of it. So if you're younger, if you're putting money into your superannuation, you've got to be careful, because it does get locked away, and the government can always change the rules upon you at any point in time. The other way you can grow your superannuation quicker is simply by just getting a better return on your money. So as an advisor, that's something we would constantly be looking at is, what's your risk profile? How aggressive can we invest through your superannuation? And what I mean by that is, how much exposure to shares or property can we hold based upon your age, based upon your objectives? Because ultimately, if we can squeeze an extra 1 or 2% return extra per year out of your superannuation fund, that is generally going to be extra hundreds of thousands of dollars by the time you would reach over age 60 and your super does become accessible. So super is always an important pillar of the advice. More so, can be more important the older you are, but still don't want to neglect it if you are in your 20s, 30s, or 40s, because it is going to be a large asset you have by the time you reach age 60, just naturally due to the government mandated contribution your employer has to make, which is 12% per year. And don't ever forget, when you put money into your superannuation, you can claim some portion of that back from a tax deductibility perspective. There are caps on how much money you put into your superannuation each year, of course, as well. Moving on to the second pillar, debt management. What a financial advisor is going to be looking at here is, one, the way I always like to approach this is, if I'm working with accumulators, we might be looking at actually utilizing debt to still scale our wealth. So we might have a family home, but we might start looking at some investment property. So the first point of call there is looking at, what is your max borrowing capacity? How much money can you borrow based upon your earnings? We're never generally going to ever recommend you borrow close to your borrowing capacity, but it's good to know what that limit ultimately does look like, because we can use debt to scale our wealth quicker, which is what we call utilizing leverage. So you could take $100,000 or let's say $200,000 in this example, and you could go and buy a $750,000 property, covering your 20% deposit plus your stamp duty costs as well. You've now got a $750,000 asset with the $200,000 that you put down as a deposit. So debt can be used to your advantage. The other part of debt is also looking at understanding the difference between good and bad debt. Bad debt being debt that's not tax deductible. It's generally put into assets that are not appreciating, they're depreciating. So think of like a car loan and buying a car, versus good debt, which is going to be tax deductibles. Think of buying an investment property. The interest associated is tax deductible. Everyone knows negative gearing here in Australia. That's one of the hottest words around. So negative gearing, the debt is tax deductible, but you also invested in taking on debt to put money into something that ideally grows in value over time. So advisors are generally looking at debt as a way to scale wealth. We do look at strategies called such as debt recycling as well, which is whereby you actually take some equity out of your principal place of residence. We deploy that into an investment portfolio, which is income producing. We take the income from the portfolio, we pay that down onto your bad debt, being your principal place of residence home loan, to reduce that, because that's not tax deductible. But at the same time, you're building your wealth, you're investing in a portfolio, and you're also getting tax savings from the debt that you've released, or the equity that you've released. Because if you release equity from your principal place of residence, if that is used for investment purposes, that will be tax deductible in nature. That is something you've got to be very careful of around debt, what the purposes of those funds are being used for. If you release equity and you go on a holiday, that portion of your loan will not be tax deductible. If you do the same thing and buy a car, again, not tax deductible. If you release some equity and you go invest into the share market, that will be tax deductible. So always got to remember these things. Debt can be used to your advantage. But of course, when we're building up our wealth, we don't typically want to hold debt when we get to the retirement or the deaccumulation phase of life. And that's where a lot of our planning as advisors will be looking at how do we use debt for how long, and then ultimately how are we going to get out of that debt? Because the last thing you want to be doing is being in your 60s or whenever retirement may be, and you're sitting on a pile of debt that you have to worry about. So both sides of the coin is what a good advisor and what we would be doing looking at. Moving on to the next pillar I've got here, tax minimization. So a lot of what we do as advisors works around not what your accountant would be doing. You should have an accountant who is always optimizing your tax, so maximizing your deductions and so on and so forth. But it's quite reactive what they're doing. Whereas what we do as an advisor is we're quite proactive. So what an advisor is going to be typically looking at is what sort of tax structures should we be utilizing for investment purposes. So that might be looking at yourself, your partner. Do we invest in whose name? If someone on a lower income, so say if you're on an income of $300,000 and your spouse is on $50,000, it might be more tax optimal to invest in your spouse's name. We could also be looking at utilizing tax structures like a family trust. We utilize those commonly for business owners, but for the right high income earning families, family trust can also be quite beneficial because you can stream income through that entity down to the lowest tax beneficiary of that structure. Family trusts are quite complex, but they can be really good for the right circumstances. They also do provide a layer of asset protection as well, but very commonly we'd be looking at utilizing these for business owners or high income earning families who want to structure and build wealth and control wealth and protect their wealth into the longer term, and then ultimately have flexibility around moving that income year to year from those investments through the trust. And that could be property, it could be shares, it could be business, ultimately down to the lowest tax beneficiary. So from a tax perspective, the advisor will really be looking at there is what structures, whose name, what structure are we ultimately investing in? And if we're ever going to start selling down on assets, how do we do it in the most tax optimized manner? What financial year? Do we utilize superannuation contributions? Do we utilize super catch-up contributions where you can go back 5 years and contribute whatever was left over in those years? That could be looking at for a business owner selling out of their business, what small business exemptions exist to lower that overall tax. But ultimately, the advisor will also always work hand in hand with what your accountant would be doing as well to provide that most optimal overall tax outcome. Moving on to the next pillar, personal and asset protection. This is talking about insurances. This is probably the least sexy part of what a financial advisor is going to do with you. However, it's still really important. What the advisor is looking at here is basically talking to you around the worst case scenario. If something goes wrong, if someone is to pass away, if someone is totally disabled, if someone can't work due to injury or illness for a period of time or permanently, if someone suffers a cancer, a heart attack, a stroke, many different conditions, do you want to have any protection there and in place? What is your risk mitigation plan, or what is your worst case planning scenario if something was then ultimately to go wrong? So we're going to play out some scenarios there. We would be talking around, okay, if you are to pass away, what would you like to leave for your spouse, your kids? Do we want to clear up all of that debt? Are we willing to sell down on assets if something happens to someone? Because ultimately, they're the considerations that we need to be thinking about, because ultimately you don't want to be building up all of this wealth and we create an amazing financial plan, but then something happens, someone's out of work or someone was to pass away, and then ultimately you have to sell it all and get rid of it all and start from scratch. So that's really where the conversation around insurance will come in. The advisor is going to talk about your needs, what your life is, how old your kids are, how much debt you have in your life, and ultimately, what your financial resources are. You could be in a fortunate situation, maybe where you have a wealthy family who would support you if something ever went wrong, and therefore you are comfortable in not having any insurance. This will ultimately always be your call, but the advisor does have an obligation to make you aware of what your insurance needs would be if there's any risk in your situation and where those shortfalls are, and then ultimately can recommend you some insurance if you want to fill the void or cover the gap to ensure if something was to go wrong, both yourself and your family are protected. The main 4 insurances that an advisor works with is life insurance if you pass away, total disability insurance if you're permanently disabled, income protection if you suffer a temporary or permanent injury or illness, and then trauma insurance, which pays out for over generally 40 different conditions or situations, but the most claimed upon are cancer, heart attack, and stroke here in Australia. The first 3 insurances can be paid from your superannuation, and your superannuation usually provides you a default level of cover. Trauma insurance is one that you cannot own inside your superannuation. But most importantly, as well, you can own the insurances both inside and outside your superannuation. Commonly, we might look at owning income protection outside of superannuation because it is tax deductible, whereas life and total disability insurances, they are essentially, you get a tax rebate by owning those within your superannuation. They don't impact your cash flow, but you do have to balance the cost of having premiums deducted every year from your super, which get more expensive as you age, against the impact of your cash flow if you pay your insurances outside of superannuation. So there's pros and cons in both scenarios there, but generally we are looking at generally structuring some through super, some outside of superannuation, just really depending upon the circumstances. All right, moving on to the next pillar, estate planning. This one very much relates back to what I've just mentioned around insurance or asset protection. One thing I forgot to mention there around the personal insurance or asset protection element is an advisor will also be looking at the structures you own your assets within. So if you're in business, there is a risk there that if something was to happen to you or your business and creditors were to come after you, they can get hold of your personal assets. So commonly would be looking at whose name do we own the family home in? Is that in your name or is it in your spouse's name if you're in business? Because you can transfer that over without incurring stamp duties in most situations. So from a risk mitigation point of view, we also do look at that as part of the personal asset protection piece. And that also ties nicely into the estate planning part of making sure that if something was to go wrong, you have your wills in place, you have adequate powers of attorney adopted. So if you ever can't make decisions or you're injured or whatever was to occur, then who can legally make those decisions for you is where the powers of attorney will come in. And the will is also very important to ensure your assets are distributed according to your wishes if something was to ever go wrong. Coinciding with that could be provisions, and this is something that an advisor doesn't write for you because you still need a lawyer to write your will for you, but an advisor can help direct and put all of this together, is maybe looking at, do you need a testamentary trust provision in your will because maybe you've got a lot of assets, you want to leave those to your kids, if something was to go wrong, but they're quite young, so they won't be able to manage it for themselves. You want to protect your assets for your kids in the event they have their own relationships and future marriage breakdown were to occur. That's where provisions of things like a testamentary trust in your will can come in handy, and are considerations that we would definitely be speaking about and looking at as your advisor. The other parts we might look at here as well is on the succession of some of your assets being superannuation. So who does that go to? Because there's only certain people you can nominate to receive your superannuation. In the event of you passing away, you can nominate your spouse, you can nominate a child of any age, you can nominate someone you have what's called a interdependency relationship with, which basically means you're generally living together and you provide some sort of financial support for one another. That one can be quite hard to satisfy. Or if you don't have anyone there to nominate, you ultimately end up nominating your legal personal representative, which basically means your will and your super is distributed in line with your will. However, what you've got to be careful of there is there are tax consequences of where that money goes and who receives it. And a lot of people don't realize that their superannuation will generally get taxed in a lot of situations, depending on who that money gets left to. One example is if you have kids below the age of 18, they can always receive your superannuation tax-free. Once they go over age 18, and if they're not financially dependent and they're living their own lives, they're independent, you can still receive your superannuation, but they will pay tax at a maximum rate of 17% on the taxable component of your superannuation. Superannuations will have two main components. One is taxable and one is tax-free. The taxable component will get taxed depending on who that goes to as a part of your super beneficiary. The tax-free component does not get taxed, but this is some planning that advisors can do, and there are ways to mitigate and reduce the amount of taxable component you have in your superannuation once you reach age 60. We can ultimately pull money out and put it back into superannuation to give your adult kids or other beneficiaries a more tax optimal outcome if something were to happen to you. So a lot of really good planning that can happen in that space. Changing gears, getting back into the wealth accumulation side of things. So investing outside super. What do advisors do and what do we typically do at Link Wealth? We do a lot of work around property. So advising around whether or not a property is a viable option for someone to consider. Now, the things an advisor won't do is we do not select property. We're not a real estate agent. However, we will factor in and work in our financial plans whether or not a property is viable for you to consider to ultimately achieve your goals. We can help you with the borrowing, the understanding of that, how that affects your cash flow, because ultimately cash flow is really important from a property perspective. How does negative gearing work? When would we sell it? What structures do we own it within? But ultimately, we don't select property. A lot of our clients will work with a buyer's agent to help facilitate a transaction like that. But ultimately, an advisor can help you figure out whether or not a property is going to be right for you. The other investments we might work with our clients around is helping build investment portfolios. So think of investing into the share market. We use managed funds, exchange traded funds. We have an investment committee within the business that looks at this stuff every single quarter. We might make some allocation changes from time to time, but this is basically investing into the Australian share market, the international share market, getting property exposure, infrastructure exposure, exposure to companies, the best and the biggest ones all around the world. Like we build portfolios for our clients. Again, it's going to be depending upon goals and objectives. How long do they want to invest for? If it's a short time frame of investing, maybe we don't want to be too growth orientated with those investments. You can always group your investments into two categories: growth and defensive. Growth assets being shares, property, infrastructure. Defensive assets being cash, fixed interest, or what we call bonds, term deposits, and the alike. So we're always looking at what that balance looks like. Us as advisors can basically recommend any investment provider that is going to be around, which is ultimately going to be suited for our clients as well. So the advice team will be creating a portfolio for you, can manage that on an ongoing basis for any of our clients, of course, as well. But that usually looks at making regular contributions into these portfolios, because this is some of the ways that we can help our clients create financial freedom and ultimately retire before the age of 60, or at least have freedom to do what they want when they want at a certain predetermined point that they're trying to seek to achieve. The other investing outside super might look around how much money we hold in savings versus an offset account if we've got a mortgage, or we might even give some advice around businesses for certain clients, depending upon what that situation looks like, because business can also be another really large asset that our clients will hold into the future that can ultimately help them achieve their financial outcomes and goals. Moving on to one of the final pillars, cash flow. This is an area that we do a lot of advice in as a financial advisor. I've pretty much seen not any besides one situation where I met clients and they were saving as much as I thought they could before they had my advice. I've only had that ever occur once. But what we're looking at here is how can we optimize one's cash flow situation? Things like not looking at utilizing a credit card for daily spend, having separate accounts or structures for various expenditures. So we might group the mortgage or rent together. We might have an account for bills. We definitely want an account for daily spend. We don't want to use the credit card for that, which is what most commonly people will do. We then have our holidays, our savings, our investments, but it all comes into central accounts and then it gets automated transfer out to other ones. We don't have any products essentially to sell or have our clients invest within. We don't sell products as a business, but we can tell you what accounts you need to be setting up, where your money ultimately needs to be flowing to get the most out of your income. Because ultimately, if we can't get the cash flow right, you can't build wealth, you can't save, you can't invest, you can't pay down your debts, you can't go on holidays, you can't live the lifestyle that you want. So getting a grasp of your cash flow is crucial, and that is a major important part of what our planning would be, is building you a cash flow structure around how to manage your ins and the outs and how you can get the most out of it. But also looking from the perspective of ensuring you don't fall trapped for lifestyle creep. I have a lot of clients earning really good income, and one of the biggest things they all struggle with is as their income rises, their expenses continue to keep pace, and it ultimately never feels like they're getting ahead. It might sound crazy to think of someone earning 500 grand or $1 million and they feel like they're poor and they can't save any money. I've seen it before. That's what lifestyle creep is. And that's really where a good advisor can come in, hold you accountable, build a structure, and make sure that doesn't ultimately occur. Because if we can't get the cash flow right, we're not going to be saving, we're not going to be investing. It really does make it hard to ultimately achieve our goals. The final pillar that we're going to finish on here is the retirement and future planning aspect. So this is really going back to the goals that I mentioned at the beginning, is understanding what you are trying to achieve, what your North Star is for yourself, your family, where do you want to be into the future, and ultimately why, and then building out a plan around that in all of those areas that I've just mentioned. And this is where in our plans, we would do projections and show you, okay, hey, if you want to retire at 50 or 60 or whatever it may be, and you want X amount of income or you want X amount for your lifestyle and you want to live this lifestyle, whatever it may look like, if you're living in Spain on an island or who knows, it could be anything. we would then show you what that ultimately looks like and build the plan around to ultimately achieve that. So that's really the retirement and future planning aspect of it. It's not ultimately always just going to be about you and not working. Again, it could be around the succession of those assets for your kids as well, and how that intergenerational wealth planning comes into the mix, which is an area that we do work within as an advisor as well. But yeah, ultimately helping you figure out what that life or what your life looks like into the future, and helping you ultimately, when the time is ready, start transitioning into retirement and doing it in the right way. Because sometimes, having an age where you just completely stop work and never work again may not ultimately be the way for you to do it. It might be better to transition into that retirement, going part-time, reducing working capacity over time, or just always just making sure, and this is what the advisor should be doing, is helping you get clarity on what life would look like at that point in time, so you don't lose yourself. You still have purpose in where you're at, what you're trying to do, because you don't work all of your life and then get to a point and then do nothing. You still need to have something and a reason to wake up every single day and have that purpose. And that's really what an advisor is going to help you get clarity around, in terms of helping you set that bigger and broader vision. So in summary, guys, those are the 8 pillars of a holistic financial plan that, again, in most situations, an advisor will be advising around. It doesn't mean in every situation they will, because in some situation, it may not make sense for you to have any debt or to invest outside of superannuation or to use a family trust. And that's why an advisor will always start with looking at your goals and your objectives before they get onto talking about any sort of strategy or areas that we should be exploring to ultimately achieve your goals. Now, I hope you got value out of that. I'm going to be closing out the podcast just now, but if you do want to have a chat about any of those areas, always best to be reaching out to a financial advisor. At Link Wealth, we provide a 15-minute call at no cost where we can talk about your circumstances and help you understand whether or not this would be valuable to you. And even if you need a financial advisor, because in some situations you might actually need another professional to work with you in terms of achieving your goals. And one final point I will also mention is the advisor's role is really to be a project manager in your life. They will help facilitate the accountant, the mortgage broker, the lawyer, the buyer's agent, any other professionals that need to be a part of your life and your journey to ultimately set you on the path to achieving whatever your goals may look like. Until next time, guys, you've listened to the Winner's Playbook, and I'll see you next week.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.